If you're 65 or older, the tax code gives you deductions that younger taxpayers simply don't get. Between the standard deduction, the age-based addition, and a brand new deduction from the One Big Beautiful Bill, a single senior could have over $24,000 in deductions, before counting a single dollar of income. Here's how every piece stacks together. Every taxpayer starts with the standard deduction. For 2026, that's approximately $16,100 if you're single, or $32,200 for married couples filing jointly. This is the foundation, the baseline deduction that reduces your taxable income before anything else is calculated. Most Americans take the standard deduction rather than itemizing, and for seniors, it's just the starting point. Once you turn 65, the IRS gives you an additional deduction on top of the standard amount. For 2026, this is approximately $2,000 for single filers and $1,600 per person for married couples. If both spouses are 65 or older, you get the addition twice, adding roughly $3,200 to your married filing jointly deduction. This isn't a credit, it's a deduction, meaning it reduces your taxable income dollar for dollar. Here's the big change. The One Big Beautiful Bill introduced a brand new deduction specifically for seniors, $4,000 per person for those 65 and older. This stacks on top of the standard deduction and the existing age-based addition. For a married couple where both spouses are 65 or older, that's $8,000 in new deductions that didn't exist before. This is the single largest new tax benefit for retirees in the current legislation, and it's available starting in the 2025 tax year. Let's stack it all for a single person age 65 or older. Start with the standard deduction, roughly $16,100. Add the age-based additional deduction, approximately $2,000. Add the new OBBB senior deduction, $4,000. Total, over $22,000 in deductions before you claim anything else. If you also have medical expenses above a certain threshold, charitable donations, or state taxes, you might be able to itemize for even more. But even with just the standard path, $22,000 of your income is completely sheltered from federal tax. For a married couple where both spouses are 65 or older, the numbers are remarkable. Standard deduction, $32,200. Age-based addition for 2, roughly $3,200. New OBBB senior deduction for 2, $8,000. Grand total, over $43,000 in combined deductions. That means a retired couple with $43,000 or less in taxable income could owe zero federal income tax, legally, without any special planning or loopholes. For couples with modest retirement income, this is transformative. Here's where it connects to Social Security. Many seniors are surprised to learn that up to 85% of their Social Security benefits can be taxable. If your combined income exceeds certain thresholds, a significant portion of your benefits gets added to your taxable income. But here's the key, your deductions offset that taxable amount. If your combined income results in $30,000 of taxable Social Security, but your deductions total $43,000, you've effectively zeroed out that tax liability. The stacked deductions act as a shield, absorbing what would otherwise be a substantial tax bill on your retirement income. 3 steps every senior should take right now. First, calculate your total deductions, standard deduction plus the age addition plus the new OBBB senior deduction. Know your number. Second, compare that to your total taxable income including Social Security. If your deductions exceed your income, you may owe zero. Third, consider whether itemizing might give you even more, especially if you have high medical expenses, charitable giving, or significant SALT deductions under the new $40,000 cap. The tools are there. Use them.
Money Unwrapped. See you next time.